Welcome to TheoTrade. This is Don Kaufman. November 2nd, 2022. There's just about 8 minutes to go to the cash close here on this Wednesday afternoon. It was a Fed day, which led to a hideous bearish break in the marketplace. And people, we are right back in the volatility box. A huge amount of this evening's video is going to be dedicated to price action in this marketplace. Listen, the Fed got hostile, okay, with rate discussion for the future. Now, we could talk Fed until we're blue in the face, but at this point, it's all about price action. Don't worry about Fed. Listen, there were hostile comments regarding future, okay, rate increases and sustainability of those rate increases for, well, an extended period of time. Neither here nor there. Let's start to break down the markets. All right. After the Fed announcement, raised rates by 75 basis points, the markets actually jumped pretty much into the, well, 39.11. Look where we're trading right now. Talk about reversals. S&Ps are actually facing about a 2.5% loss. We are down just shy of 100 handles on the S&Ps at this present time. Nevertheless, it's the Nasdaq that's actually taking the brunt of the hit along, okay, with the Russell. And we're down over 3%. And yeah, there's still time left on the clock and heavy sell side activity. One of the first things I want to bring into the equation over here, okay, isn't just, the raging sell side activity. It's some of the damage that was inflicted expressly to the SPX. Okay, here we are. We had approximately $118 expected move this week. And I said to you on the weekend update from last Friday, I go, untrusted as far as you can throw it. You're looking for a $118 move. Where are we right now? We've already broken through the lower edge of that expected move. What I want to really deliver to you, and you got to understand what this amounts to, okay? This is some of the most hostile territory you can be in for the marketplace. Listen, the edge, the lower edge, I should say, of the SPX expected move, right? Coming off of that, again, is rather dire for the marketplace because it implies that anybody and everybody that has got, okay, directional risk, for instance, market makers, dealers, they've got to hedge in the direction of the marketplace because we lost 37, approximately 83. 37.83 is the lower edge of the SPX expected move. Right now, we're trading about 37.60-ish. Okay, now there's a chance into the cash close we can bounce back up into it. You can see we were holding the line, okay, for a matter of about 15 to 20 minutes. But listen, losing this is where in the middle of the night you could see some wild price action and continued sell side activity. So as the Fed got hostile, it has actually broken us, okay, lower than the expected move in the SPX. It's where I wanted to start tonight because when it comes down to it in price action and there's just 5 minutes left to play inside of the marketplace, this is what's going to matter most for the remainder of the week, trying to hold the edge of the expected move, because if you lose it, you start getting, 2 and 3 sigma moves. And you got to realize on a 118-point expected move, to see a 2 sigma move, you realize that implies like a 240-point down move inside of the S&Ps. On another front, we have now dropped back into the volatility box. Again, bearish break and back in the vol box. The vol box is also, okay, critical in terms of understanding price action. For those of you that are a little bit newer here at TheoTrade, I'm going to go ahead and freeze the screen for a second with just 4 minutes left inside, okay, of the trading day. This is our volatility box. Volatility box runs from basically 3,600 up to about 3,800. Specifically, I tagged the upper edge of that volatility box right around 3,811. Closing now, okay, below it. And again, I am highlighting that for you so you guys can see exactly where price action is. Because we actually traded inside this vol box for such a significant period of time, you have to understand there is critically huge amounts of open interest in here. Okay, as such, we're actually going to be driven back into the box. Volatility is going to start to rage once again. Speaking of volatility, okay, that's one of the things that everybody's asking today. They go, why is the VIX not moving? Okay, I got a reason for that here in just a minute, but it definitely relates to the fact that we're right back inside of the vol box. And being inside of the vol box, okay, and the reason I wanted to relate this together is This is a comfortable place for the marketplace, right? The marketplace actually knows this turf really well. So when you start thinking about where's the volatility, okay, well, we're going to cover a little bit more of that in just a moment. But where's the volatility? Why should the VIX go flying up right now? This is not just well-charted territory. This is territory we've been in for what? Umpteen days and umpteen times, okay? And that's exactly the point to be made out of this. Now, before I get more down the road of volatility, okay, you got to look at what sectors have been holding this marketplace together and perpetuating a significant rally. One of them of which has been the financials, okay? You got to watch this tomorrow. You got to watch this Friday morning, right? Why Friday morning? Jobs numbers coming out. The financials actually turned. It's one of the biggest, okay, reversals on your screen. The financials were loving it right up until the point they completely reversed course. So what? They're only down 1%. That is my exact point here. The S&Ps are actually off by 2.5%. The Nasdaq has taken a 3%, hit on the chin. Russell, okay, getting whacked hard. The financials are like, this is nothing. This is a breeze. I can handle this. And that's why you need to be concerned. You need to be concerned because if the financials do really break, okay, you're going to have some serious trouble. In fact, until a few minutes ago, I saw on my screen, I was looking down the list, some of the usual suspects. I saw Goldman Sachs up. In fact, here, I'll pull it up. Okay. I saw Goldman Sachs actually trading higher. Okay, and significantly higher on the day. And well, lo and behold, here it is. It's still up $1.37. So if you're looking for areas, and again, I am carrying positions in here, but if you're looking for areas and strength in the midst of, pretty horrendous trading day, this is where, don't look at this as being, a bullish indication. It's the exact opposite. If this is the break, Goldman Sachs is the break. And again, looking down at some of the other banks out there, okay, here's Goldman Sachs is still, again, up 0.3%. All right, Wells Fargo flat on the day. Morgan Stanley up 0.8% of the day. Right, sell into it. Why? Because this is the area. If we're going to break, and we're really going to break deep into the vol box and come back down to that 3,600 and threaten the lower edge of the vol box, financials are actually going to be the pivotal role in it. And I cannot stress that enough. Goldman Sachs, I already happen to have a short position in there. I'm already short a couple of hundred shares of JP Morgan, and I have a nice, big, fluffy position inside of none other than the XLF. I'm short about 1,200 shares there in the XLF, booking about a 4 to 5% gain. So I am short inside of the financials. Bring the pain, people. S&Ps are going to close down here, just about 100 handles. So financials, they've been holding markets together. Next in the docket here, energy. If you're in energy, be afraid. I'm going to tell you right now, and I do not mind saying this, I am short in the energy sector. I've been getting ripped apart. There is the closing bell, and lo and behold, right on the button, about a 100-point move down. Nasdaq losing about 400 handles today. Energy sector. It's a fairly critical reversal inside of the energy sector. It's getting whacked back. This is another major sector that I say be afraid. Listen, the Fed talked about considerably slower growth for an extended period of time. Do you think that that is going to be bullish for energy? I'm not going to get all fundamental on you here, okay? But that's all I need to hear. Okay, I am going to sustain what has been a horrendous position for me. And again, I've got all kinds of positions, but I'm down approximately 30% on 600 short shares of the XLE. Okay, I may not like it, but I got it right where I want it. So I'm going to maintain, the energy position, because energy at this point, right? To me, this chicken is done. This thing is ripe for the plucking. You should see some more sell side activity and energy in the days to come. Looping back to where is volatility? Okay, where's Waldo? Don't look for the VIX to actually rage on the fact that the S&Ps are down, 100 handles. And that's really perplexing to people. As I said, we're back in the volatility box. This isn't just well-charted territory. This is like old hat. The one thing, though, that is worth noting in here, if you look at actually the volatility futures, they're really close to coming back into backwardation. So we're a hop, skip, and a jump from backwardation. You realize that tonight, this is going to be the Fed shot heard round the world. And I'm going to make that clear. Like, this is going to be the Fed shot heard round the world. And you may sell off considerably in the overnight session and wake up into, well, a little bit of a crap fest in the marketplace, but don't necessarily look for VIX to climb, okay? The next thing we've got to discuss. I don't know where SKEW is going to close tonight, but SKEW, I mean, as I put here in the scratch pad up here is oh my holy SKEW. Okay, SKEW is the most intimidating thing that I've seen in, well, years. I'll open up a max chart here of SKEW, and SKEW is actually all the way down to 111, which is effectively one of the lowest prints it's ever had. The problem with that, if we start to go down, it's going to perpetuate a wild and woolly sell-off. The issue with SKEW being low, for those of you that don't understand this, I'm going to give you the abbreviated version. SKEW means that the out-of-the-money puts are not carrying a heavier implied volatility. Okay, if traders are going to go out there and start to buy puts, which they typically do in down markets, they either buy those puts as hedges or they're buying puts because they think the market's going to go down. As traders start to reach for puts, market makers have to sell them the puts. Okay, think about this dynamic for just a second, because we have an inherently low SKEW, which means it's really low, okay, implied volatility of the out-of-the-money puts. So all of a sudden, you turn around, okay, and buy puts. You create negative delta. The market maker, this is the MM, okay, has to sell you those puts, which produces positive delta for them. That positive delta, okay, ultimately gets laid off by them selling S&P futures. What do you think is about to happen now, okay, with a 111 SKEW? Why do you think I just said over here, oh my holy SKEW? There couldn't be a possible worst case scenario right now in terms of SKEW, because if you start to reach for puts, okay, they're going to start to do what? Smoke the S&Ps. Look out right now. All right, that is not supposed to be a bearish connotation. That is a promise to you that if we start to go down, we're going to go down heavily, we're going to go down hard. All right, where bonds actually break us. In the days to come, you really got to start to think about bonds again. Why? It's a teeter-totter here at the 120 level. We start to break through 118. Okay, or even like down to the 116 level, people are gonna freak. And again, what you actually heard out of the Fed today was a lot about what we term terminal rate. Terminal rate effectively means, when is the Fed gonna stop raising and then start to actually lower rates? The answer to that is, yeah, find out in the next Fed meeting out in December, maybe. All right, there is no terminal rate right now. There is nothing pretty talk about in this marketplace. Dollar is bid, okay? Don't look for the VIX to necessarily get wild over there. And last but not least, yeah, don't forget jobs. You still have a jobs number coming out, okay? It's another catalyst to actually spark fury inside of this marketplace. Take a look, all right? We still got to go through what? Thursday, okay, Friday, but take a look at the Friday expiration. Yeah, only a $73 expected move between now and then, okay? I actually suggest to you implied volatility is going to pick up substantially in both a Thursday and Friday expiration. That overnight trade today, this is one of those evenings where I'm telling you, watch markets overnight. This is going to be Mr. Toad's wild ride. You could actually wake up tomorrow into a 3, 4, even 5% move inside of this marketplace. Lo and behold, I think the marketplace actually handled the Fed announcement today rather well. The Fed press conference, again, they handled it rather well. We only closed down 2.6%. Again, bearish break in the marketplace, and we are so very back in the volatility box. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.